So welcome everyone to our panel today on raising a Series A round. My name is Tony Williams, and I am the New Ventures Associate at Princeton's Office of Technology Licensing. And very happy to be here with you today and leading this panel on raising a Series A round. This is part of a lecture series that is being, a panel series that's being brought to you combined by the Princeton Entrepreneurship Council and the Princeton Innovation Center's Biolabs. The Princeton Entrepreneurship Council is the hub of all entrepreneurship activity at Princeton University. It was first founded in 2016, and its role is to provide a network and support to all entrepreneurs from the Princeton University entrepreneurship community, and provide the support and programming to help them in their entrepreneurial endeavors. The Princeton Innovation Center's Biolabs is a 30,000 square foot co-working space for all types of scientific startups. It's based in central New Jersey, just across Route 1 from Princeton, and is a home to a burgeoning and growing number of exciting scientific startups. And so both the PEC and the PICB are very happy to bring this lecture series to you. So this is very much a sort of open panel discussion. So if anyone has any questions for the panelists, please don't hesitate to put them into the Q&A, and I will try and integrate as many as possible into the conversation today. And also, yes, so without further ado, let's get started. I'm just going to begin by asking each of our panelists to introduce themselves, their companies, and also just tell us just at a very high level a little bit about their most recent funding round. So Kristina, can I start with you, please?
Sure. My name is Kristina Fontanez. I'm currently the Vice President of Biology at Fluent BioSciences. We are a 4-year-old startup based in Watertown, Massachusetts. We're developing reagent kits for the life sciences. In particular, we currently have reagent kits for single-cell RNA sequencing currently available. My background is multidisciplinary. My training is in molecular biology and microbiology, and I've had the privilege of working on the development of multiple life science products, including a DNA sequencing platform and droplet microfluidics platforms. I've been with Fluent since before the founding of the company, and we started out at 2-3 people, and now we're at over 30. So very excited to have been and seen this company grow so much over this period of time. And our most recent fundraising round was a 19.3 million Series A in 2020.
Great, thank you very much, Kristina, and it's fantastic to have you on the panel today. Fei, can I ask you to sort of introduce yourself and your team and perhaps your most recent investment? So.
Hi, so very nice to see everyone here. Thank you for inviting Tony. For me, my name is Fei Shen. I'm the managing director of Boehringer Ingelheim Venture Fund in the US here. So we are a strategic venture arm of Boehringer Ingelheim, the pharma company. Myself, I'm trained as a neuroscientist, worked in both small biotech as well as large pharma, being Boehringer Ingelheim research for 15 years before switching into venture fund about 2 years ago. So the most recent investment we did actually is from Princeton University. We spun a company called Arapath, which is using machine learning and AI for novel mechanism of antibiotic discovery platform out from one paper published by Zimmer Gatai 2020, I think, June time. We read that paper and we together spin a company together out, did the company formation. So we, in the end, we got 20 million for Series Seed globally for this company and closed late last year. So very happy to be here.
Great, and we're very happy to have you, Fei, and thanks so much for joining and providing the investors' perspective on this sort of interesting issues. So. And last but not least, Mark, would you introduce yourself and KayoThera, please?
Great, thanks, Tony. So I'm Mark Esposito. Was originally a grad student at Princeton, joined in 2011, and in 2017, Tony actually helped us to bring in some initial venture grants to that company. We spun it out of Yip and Kang's lab ultimately in 2019 with a seed investment from New Jersey Health Foundation. And then since that point, I led the company as the founder and CEO, and recently led a Series A transaction with Accelerator Life Science Partners, BioAdvance, and 7G BioVentures. I also do consulting work with some other companies in the area. And as a result of that, at fundraising, I got demoted down to VP, but everybody's pretty happy about that. So happy to answer any questions.
Great. Thanks so much, Mark, and great to have you on the panel. So just a reminder to everyone in the audience, please don't hesitate to put any questions you may have for the panel into the Q&A. We want this session to be as interactive as possible, so please do. But in the meantime, we'll sort of get going and start with, I guess, a sort of, very broad overarching question. So if I'm a founder of a exciting startup, I'm thinking, okay, I'm ready to go out and raise that Series A. How do I best decide who are the best funds to approach? How do I understand which particular funds are going to be a good fit for my company at this time? And Mark, I might actually start with you on this one, if that's okay.
Yep. So the key thing, I think, is a lot of people will be interested in hearing your pitch when you come over. Many venture funds spend time just information gathering in the field. But really, as the entrepreneur or as the head of a company, you need to be selective in those companies or those VC funds or the angels that you go and approach. There will be groups and there will be angels that are relatively agnostic to the modality and indication that you're in. But by and large, you're going to want to be very selective and pick the VC funds that have a portfolio of companies that look somewhat similar to the therapeutic space that you're in. So there's two sides to that. One side is the indication. So are they cardiovascular? Are they oncology? Are they neurology? Do they combine across a couple of those indications? It will be very hard to get a neurology-focused VC fund to be interested in an oncology or a cardiovascular type company. On the flip side, you also need to be very aware of the modality. Is it a platform-specific type group, so something like the Arches of the world? Or is it really a therapeutic first, single to multi-asset type of company, and those would be VC funds that are more like Fraser. And then finally, I think that Fei can perhaps speak about, if you're talking to instead of the conventional VC funds, if you're speaking instead to strategic type funds, then there's an entirely different metric that you need to think about.
Right. So, Kristina, any thoughts from your side? How did you sort of pick out and choose sort of VC funds that are a good fit for your fundraising round?
Yes, sure. Yeah, I definitely want to echo what Mark said, but we're coming at it from the perspective of a life science tools company. And so you certainly need to do your research on the venture funds, because there are some that don't really invest in life science tools and prefer therapeutics. And so it would be a waste of your time to meet with them when they really don't have companies like yours in their portfolio. And certainly after you've had the experience of meeting a great many VCs and angels, then you have the opportunity, as Mark said, to be more selective, because you have to start thinking about, this is not just money coming in, this is expertise, this is networking, and you actually want to start getting references on the people that would potentially be on your board. You want to know what they're like with the other entrepreneurs that they work with, because it's not just about the fund and what they've invested in, but also the people that you'll be working with day in, day out. I mean, you're going to be in several hours long board meetings frequently with these people. And it's very important that you have a good working relationship and that they're bringing to your board something that will help your product or your therapeutic really move forward in the commercialization and development process.
So Fei, can I ask your opinion from the investor side? So, what do you recommend for companies that are trying to decide, where is the good place for me to seek my sort of Series A financing? Who are the right people that you're looking for to come and approach you?
Yeah, so I would say the number one step is every fund you want to approach should already have a website. Go on their website to look at their portfolio companies. So, and then also look into pitch book. That's usually a good two combination to tell you what stage these funds are like to buy in. That's important, because to talk to a fund, usually do the late stage, to ask them to give you seed money, that's unrealistic. but certain fund are much more familiar doing their very early seed-led kind of fund. For example, our Boehringer Ingelheim and venture fund are very familiar for company formation, spin things out of academics. That take a different kind of mentality and talent pool, even in their fund, to really help you do such thing. So I would say first very carefully look at usually have a team page, look at each investor's background as well as their portfolio, which stage they usually buy in. That's usually good homework to do before you talk to a fund. But I think like Mark said, a lot of fund out there is looking for just information gathering, but it's the same should be for entrepreneur as well. You should information gather as well. But the first thing, before you even give them the pitch, you ask like if you able to get 1 hour from that fund for introduction call, you first ask their investment strategy and ask them what stage they like to put in, what's their check size. Usually people are pretty happy to tell you what their investment strategy and look like. That's the initial dating piece. If you find a kind of mutual, we want the same thing in the end of the day, now we can really start talking about, science. Usually some fund are definitely more interested in science than the other are more interested in business idea and strategy. So I think these are usually pretty good information you can find in public domain before you even talk to the fund. But I think I also agree with Kristina that not all money are the same. It's important to know what you want. So if you want to find a trusting relationship and have a board member can help you in all dimensions, you also need to check reference from the look at the portfolio CEO you worked with in the past. So I think all these are comprehensive information you need to take in consideration before you decide who to invite you into the table and sign CDA with, have serious discussion.
So thank you very much, Fei. So first question coming in from the audience, and this is a really practical one. So how did you go about, once you've identified VC funds that you think might be a good fit for your companies, how did you go about making first contact? Was this always a warm introduction, or if not, did you sort of cold contact people, and if so, how did you find their contact details? So really practical question. Kristina, can I come to you first on that?
Sure. Of course, warm introductions are always best. And so networking events are really important because getting those warm introductions is often the difference between you getting a call back or not. And so for us, it was reaching out through our alumni networks, certainly. And then, of course, any entrepreneurship networks, just like Princeton, going to events at incubators and accelerators and meeting other entrepreneurs. Because sometimes it'll be other entrepreneurs that will introduce you to VCs that they've spoken with that perhaps were not a good fit for them, but now they know a little bit about you and then they make an introduction. So it's a whole lot of networking. But of course, you can cold call and sometimes you will get interest that way, but it certainly was for us the least effective method rather than a warm introduction of some type.
Mark, any different sort of experiences from your side?
Yeah, something that I did was when I started out, I thought that we only need to hire scientific expertise into the company. And what I sort of came around to in the end is it is always nice to hire 2 to 3 people into a commercial advisory board. And those 2 to 3 people should, they should have gray hairs already. They should have been in the industry for a very long time and transition between large pharma, venture, small startups, and those people will have collected the network that you need already and will provide you the conduit with which to reach out to investors.
Fantastic. So thank you. So okay, so my next get into the question about timing then. So when is the right time to sort of be going out and looking to raise a Series A? And the question from the audience is it ever too early to raise that capital? Fei, can I come to you first on the question of timing?
So I think that's a loaded question, to be honest. It's difficult to answer. There are no like formula, say if you meet one ABC, then you start to raise. I think it's important that you have, if it's a platform technology, you have an example of what you think could achieve or some plan. I think you need to be a very solid plan. That's the important thing. If you have a solid plan, see where the next inflection point to be and put a plan behind that to see I can pay my road towards that inflection point. If you have that in mind, it's never too early. like a BI venture fund will see the things just in conception phase. You have no data, no even in vitro, in vivo data, only concept. If we think it's good enough, if the entrepreneur is open-minded to work together, to shape things together, that's good enough. Some founder will say, I want to see in vivo data before I even can talk. So I will say, again, that kind of dovetail into your first question is, every founder has different appetite. Some people are more risk-taking. Some are need much more comfort. See other people biting in, then I will go in. So I will say, yeah, I will say never too early, to be honest, if you are having the goal to forming a company to commercialize your transformative technology.
Great. So thank you, Fei. So moving on from the timing, I guess then the related question is how much to raise. So Kristina, can I come to you and ask, how did you end up at the figure you did of sort of 19 million or so for Fluent? So.
Yes, I mean, for us, it seemed like an enormous amount of money going from, seed rounds that were quite a bit smaller, but much smaller than therapeutics company would raise. And so, we were looking at it from the perspective of having to build a team and make sure that we were building out our capabilities for production, but the vast majority is spent in R&D. And so cost-wise, having people on your team, like Mark said, that have been in the business and understand how much these things cost is really important to building out a plan, because you should have an idea of how you're going to spend the funds. You can't go into a room with a VC and say, I want $19 million. And then when they ask, well, how are you planning on spending it? And you don't even have a slide about that. That's a waste of everyone's time. So like Fei said, you must have a plan. Not just how you're going to build out the company, but how you're going to spend the money on kind of at least a quarter by quarter, but really a burn down basis. So you have a sense of what the value is that you're bringing, to the field, because you have to justify that in terms of your VCs. And so I would say it's a combination of, expert experience from people that have been through and built these types of tools before, conversations with lots of VCs, and a lot of back and forth to come to the number. But ultimately, for us, we ended up raising a little bit more than we'd anticipated because we were initially oversubscribed. And so during the process of term sheet negotiations, we ended up adding more investors as part of that process. And so I think it's going to be different for every company and what your needs are. But of course, you want to avoid raising too much money, because there are other considerations of timing and how that changes the valuation of the company at different time points. So there are a lot of considerations that really merit, like Mark said, having experienced a board of advisors that can speak to those types of questions.
Right. Thank you. And Mark, any sort of further insights from you and your sort of recent Series A?
Yep. Yeah. Right. Sort of on the back end of what Kristina said about not raising too much. We were approached we had this initial investor who was interested, and then we were approached by many people that wanted to follow on, and our initial investment would have swelled actually to larger than what I think we could have used initially, and that would have been beneficial to the current shareholders. So as management, when you start out with, you do have fiduciary duty, and part of that duty, I think, is very expeditiously planning where that funding is going to go. So at least in therapeutics, it is extremely well codified how you spend money and how much money you need to spend at a certain stage. And it sort of falls into an order of magnitude. You've got many therapeutics companies that seed right around $1 million. Their Series A typically is in the 10 to 20 million range. And then up in the $100 million range is when you're financing clinical trials. For us, we were already through the sort of discovery stage, and right now we're just starting on the development stage. So it was actually, quite clear that we need to raise right around the $10 million amount.
Great. So thank you, Mark. Fei, can I come and ask from Boehringer Ingelheim's perspective, how do you approach this issue? How do you decide how much money you want to sort of put into the sort of early stage companies that you're investing in?
Yeah, so I think we always tell the entrepreneur, not more is better. Sometimes I think the misconception is more is better. Again, more is better has a condition in certain environment. Like right now, I will say right now the market is pretty low. Winter is coming, perhaps, or maybe long winter, we don't know. I think this kind of time, sometimes we'll be a little more forgiving on giving a little more money, try to get much money as you possible in this kind of environment to prepare you for the long winter. But normal I would say rule of thumb is getting yourself enough to the inflection point. So that's, I think, the key, just like Kristina said. In the next inflection point, your valuation of company will dramatically increase. Raising too much more early on in a lower valuation time point will diluting out the fund dramatically. So that's, I think, the key information entrepreneur should keep in mind is not more is better, but that does not apply to all the time.
Thank you, Fei. I'm actually going to come straight back to you with a question from the audience, which I'm not sure I would know a good answer to. When, or I guess the other question is if, when would it ever make sense to bring investment bankers into the discussion?
I will say investment bank, if we see anybody reach from investment bank to us, that tells you cannot sell yourself. That's usually, I will say, standard for the past few years. Things might change, I don't know. But at least I would say investment bank deal flow is they usually do is take a cut if they raise for you. So that means if you can raise yourself, you would not ask other people to get a cut, right? So that's not a standard practice. So I would say investment bank is your last resort. If you absolutely cannot raise, you exhausted all your network, nobody say will give you money, you can try investment bank. The chance is not very high, at least in the past market practice, but things might change. I would say our field is very dynamic field. There never rule apply forever.
Yeah, I 100% agree with that. So there is some middle steps between that. So we were approached by a ton of investment banks, and they're not raising for you; they're raising for their own service fee on it. And it's definitely a rough mark, I think, to have. There are some intermediaries, which are some of the crowdfunding sites and some of the ones that some of the accelerators that they are providing you with access and they are providing you with some services. We didn't personally use them, but I do know other companies that have used those, and it isn't necessarily the same look as having an investment bank do it for you. So things like Fundable, some of the crowdsourced ones, those are not like a complete. They aren't a black stain. So those aren't terrible.
Great. So I'm going to sort of switch tack a little bit from these sort of I guess sort of macro issues of who to approach and how to approach them, to talking a little bit about team, because I know basically every venture capitalist or investor you talk to would always say that team is the most important thing. What should your team look like when you're going into this Series A fundraising process? And Kristina, I'd love if you could sort of start on this issue.
Sure. Certainly you need to have someone with experience as an entrepreneur, preferably someone who started another company before, that knows what it's like to be in those rooms and to have the conversations about the company and valuation going forward. You also need to have someone that knows your tech, whether it's a therapy or a tool, and knows it intimately. So you should be able to go very high in terms of the conversation, like you're speaking to your grandmother, and then very deep, as if you're speaking to the world expert in the field about your product. And it's very difficult for that same person to be, the CEO. It can be, but having more than one person in the room can often be helpful because you're bringing in these two different perspectives about it. And so I think we found that to be a very productive kind of tag team effort. And those are just the people in the room. Beyond that, you want to make sure you also have on your slide people that sort of fill the gaps in the expertise that you have, whether that be someone on the commercial side or someone that has another key expertise that you need to build your product, because you're going to need to talk about that person and why they're important to your team. I do want to echo, the team was a large part of our Series A fundraising success. We spent a lot of time talking about that, and we did get very good feedback from investors that this was important to them, and they appreciated how deep we went in explaining our perspective and the value each team member was bringing.
Great. Thanks so much, Kristina. Mark, I know you've already sort of touched on this issue, but how did you go about sort of constructing your team sort of leading into your sort of Series A round?
Yep. When I looked at our next major inflection point, which is an IND application, I just pretty much looked at the modules of that IND application. Who do we need to have on board in order to successfully submit that? And who can we bring on board that will help us hire the other people? that we need in order to submit that IND. Of course, there's peripherals. You need to have a fantastic legal group around you. So you need to really pay attention to your corporate and intellectual law, and those are always going to be two different people. But otherwise, if you look towards the inflection points that Kristina and Fei both spoke about, it's very clear what team members you need to push towards that inflection point, and you don't necessarily need anybody else in addition to that. So you want the minimum essential, just like you're making an MVP for your product, you kind of want the minimal essential team around that too. Because otherwise that's a lot of payroll, and it's just people that you need to find work for as well. So, I made one or two of those hires and kind of regretted it and had to walk it back. So.
Okay. And Fei, I'm going to come to you on this question in just a sec, but for Mark and Kristina, can I ask just about the sort of practicalities of finding people, particularly those, as you mentioned, you sort of referenced Mark, people with sort of gray hairs, the sort of senior experienced advisors and mentors. How do you go about finding those people to sort of help you move things forward?
I can jump in here. So, for us, it was a lot of networking because we had people at the company that had experience as entrepreneurs. They had networks. And of course, our board members had networks. They made a large number of introductions to potential people that allowed us to then make secondary introductions. So I hope you hear that we're emphasizing networking a whole lot here in a lot of these answers. And we also attended conferences, investor conferences, and we spoke to a lot of people to, get a sense of who the right fit might be for these different roles.
I'll make a plug for some of the accelerator programs that are being put together. There's a large number of them that are no fee, no equity. They're just there sort of for furthering the field and fostering networking. So we took part in NYU's Endless Frontier Labs. There's several others that have emerged, like Creative Destruction Labs up in Canada. Some of the Mass Bio, they also put together quite a few of these. Those are fantastic for meeting everybody that you would ever need to meet in a structured environment that sort of forces the interactions.
Right. Thanks so much. So Fei, I'm going to come to you on the team issue. I know it's sort of a little bit different for sort of BI, but when you are sort of hearing a first pitch from a prospective new venture, so what do you want to see in terms of team construction? What are you looking out for, and then how do you go about sort of complementing that?
So I actually first would like to kind of challenge a little bit for Kristina and Mark the notion of very experienced. We all know have experience, great, but we all have first-time CEOs start from just coming from entrepreneur world, right? They want to be first time. That not naturally means they're not good enough. So I will say we're quite open-minded on that. One philosophy we do believe, why we believe teams important, because we do believe that A team can make a B idea work, but the B team will ruin an A idea. So if you have an A team, and a team actually mean multiple level, I feel. Not only the company perspective is one part for the team, people look at it, that's initial, but when the team build out, the board is part of a team too, because I see board ruling the company as well. So SAB is another portion of the team, is also very important, need to pay attention to. So really the teams really structured in multiple different folds, all have to pay really strong attention to build a complementary, balanced team and help to shoot together for the common goal the company put forward for the inflection point. So let's just focus on what company kind of structure when we normally would like to see. The most important part for us to see is whether the team is open-minded, whether it's shapeable team, willing to work together. I will say, investment time, probably investors' time is much more precious than our money, to be honest. I always tell entrepreneurs, it's hard to believe that actually a few $1 million here and there is not that our bottleneck, at least for our venture fund. The most important is our time. If we're willing to go down this path with you, it's almost like a marriage. We're locked down for another 5 or 6 years. It's a lot of time where each of us sinking into this together. So I remember at the beginning when we forming company with Zimmer, it's 2 hours every week on phone, multiple times a week. It's a lot of time for us to really going down this path. If I feel the people, the scientific founder or the CEO reach out to us, is all we need is your money. That's not the team I want to work with. We would like to form a partnership, brainstorming together, solve partner together, including like, if we forming company like this case for Aeropass, we find the CEO, we searched globally. In the end, we find Roy Ping, which is very fortunate. I think why we convince him to take this company is we invite him as a partner. We do not tell him, because scientific ideas coming from Stanford, I give you the money, you do whatever we tell you to. That would not form a good team. The team is about respect to each other and truly really working hand to hand, because it's going to be challenges along the way. We know that every company has challenges, but you got to build the trust and open-minded, willing to listen each other out, and really coming together, put your selfish ego behind it and shooting for the common goal. That's the feature we're looking for in the scientific founder, as well as the C-level people from the company. Sometimes are the same people, but that's the critical feature we're looking for before we are willing to invest.
Great, thank you so much, Fei, and thank you to everyone for, we always hear that team is the crucial, most important thing. So thanks for all your varied perspectives on its importance. I'm just going to throw in a couple of sort of questions from the audience before we get into sort of questions of structure and process. So firstly, are there any sort of life science or investment conferences that you recommend as sort of good venues for networking and potentially sort of meeting new VCs and or team members? There are it's like sort of bio or Resi. Are there other sort of conferences that any of you have found helpful or effective places for networking?
I can jump in here.
Sure, please.
So certainly Resi was valuable, but I do want to kind of echo what Mark said about the Mass Bio. We were a Mass Bio finalist and other incubators. They have a lot of different events that sometimes are conference-like that are really great places to have those conversations. But for us, the big one was JP Morgan. I think that's the big one for everyone. And that was a place where we made our first relationship that led to our Series A.
Fei, in that respect, are there any sort of conferences that you regularly attend and you found a great place to meet sort of incoming startups?
Yeah, so we do have different colleagues monitor different kind of conferences. For us, because we're going so early, we are seed-led kind of on the team. So I would say, yeah, so we do have people monitor Resi, and each of us are sitting on different panels, a different mentor board. Like, for example, Mass Connect, many, both Kristina and Mark already touched upon. That's kind of like we are normally be part member of, and we're together not only kind of mentoring the entrepreneur for 8 weeks to polish their talk, but also meanwhile is a way of two-way communication, able to see whether the team is open to feedback, what's their response to mixed kind of audience feedback simultaneously. So that's a really good, I will say, don't give up any opportunity for network. Going back to the network, I will say there are different forum, and also to do with how your behavior during this period of time, and also follow up with certain network you already planted seed with. It's continued culture, the relationship is the key, I think. But I will say, yeah, JP Morgan, actually, we did not really have too much good opportunity to looking for the very early piece. JP Morgan mostly for us to connecting with the other co-investors, at least for our experience. But I will say some other meetings globally now, actually, everybody is doing that. Some are in Canada, some are in, I would say, Europe. That's all very small. I would say the important thing is for your stage of a company, looking for the right stage of conference to go into. That's, I would say, most time efficiently spent for the C-level people, because you're all very busy. And one thing I would just want to say, a lot of companies, like all the 20 big pharma, doing a lot of external innovation process. For example, our BI, we will do office hour. What we do is like a panel of people from each department discipline. We will form a panel to go to different hubs. For example, New Jersey will come towards the end of the year. North Carolina, we do all the different hubs, I would say every month. What we do is gather kind of different proposal from different entrepreneurs. They say, I have an idea, want to form a company. I only have a concept. you're a big pharma. What were you looking for? Like say file IND, I have this concept. What kind of a research proposal you were looking for when I form a company? So we do that, a lot of kind of feedback to ecosystem and to help ecosystem. We call it grassroots innovation. We do quite a lot of these kind of events. And I believe every big pharma is trying to do the same in a way, utilize this opportunity, sign for their program. It's free advice. We don't ask for anything in return. We don't ask for you sign deal with us over there. The reason is we really took together, plant the seed early, and hopefully form a connection and grow this together organically. That's kind of goal for the relationship.
Great. Thank you so much, Fei. I'm actually going to come straight back to you, if that's okay, with another question from the audience. And I know, at BI, you tend to invest very early. So I might maybe asking you to put yourself in the head of sort of other investors. But does it make a difference for you whether a company is coming to you looking for its first round of funding, having sort of bootstrapped its way there, or if they already have raised seed funding from angels or foundations or other groups? Does that make a difference to you? Does that make a difference to other investors?
I would say for us, not quite make a difference whether you already get some angel money or you are completely just have one paper and I look for you. So I would say they're not really fundamental feel different for us. We only really have a very clear, very strategic mandate for what kind of therapeutic, what kind of digital health we are investing into. That's kind of two area. We have therapeutic 3/4 of our people and effort and money all going to. 1/4 for our is going to digital health. And we have very clear strategy listed on our website, what type of asset we're looking for. Whether they already have a little money or no money, it really makes no difference for us. But I know that if you come in to me, you say, I'm close to IND already, that's too late for me. That would not be my first bite. I will say, I wish we met maybe 2 years ago, then I will be much more interested in, because we feel the talent pool we have in our fund is very suitable of sitting on the board with you together go through the discovery and really working together, doing the heavy lifting together with you to moving company to a much more, I would say, stronger inflection point with much more efficient spending of your budget. So that's kind of our talent pool is. That's why we're doing the strategy we're doing. But I will say every company, every fund has very different appetite. So going back to your first question, go on their website, look at their portfolio, and also look on PitchBook. When do they enter that particular company? That can help you determine what do you do.
Great, thank you, and thank you to the audience for all the sort of questions. You're really keeping me on my toes, trying to and keep these all in line and keep the conversation moving forward and answer everything that you'd like to know. But please keep them coming in. So a quick question start with you, Kristina. So location. So where were you when Fluent started? Did you move? Did you find being based in a particular geographic location was more helpful?
Yes, we actually started in Boston's Chinatown at Tufts Launchpad with just a single bench. And we ended up moving multiple times as we grew because those places are great for connections, networking, like we've talked about. At that time, we had some seed funding, but we were also actively applying for non-dilutive sources of funding. So we haven't talked extensively about SBIRs, the Small Business Innovation Research Grants. We have been very successful with those grants, raising over $4 million in non-dilutive sources of funding, which certainly at that stage was really critical for us to get through some lean times. After Tufts Launchpad, we moved out to Arsenal Labs in Watertown. So this was another sort of pseudo incubator space that allowed us to have a private suite. It was very cost effective for us, and we expanded a lot there. Because Watertown is kind of a growing, booming place outside of the Kendall Square area, we were able to expand within that building and then across the street. And then from there, we were able to expand just this past January to the building you see behind me, which is also in Watertown, 13,000 square feet, enough for 55 plus scientists. And so this is our latest location. And that was obviously available to us because of the Series A. And it allows us to consolidate what was 2 places across the street into one, which of course allows you to have more efficient processes and give us some elbow room to kind of grow.
Great. So thank you, Kristina. Mark, I'm going to come to you because I know, KayoThera's history was sort of very, very different. But could you talk a little bit about, how you approach this issue?
Yep. We sort of got smack square on by the pandemic starting. So we had one plan and then quickly went to another plan. We were fortunate in that we're working in the oncology space. So there were a lot of solutions for us throughout the US, throughout China, and throughout India, where we could bring in our expertise at the C level and at the consultant level, and then actually direct our direct CROs to sort of take the space of work that we would have been doing during the pandemic. So as the technology and as that access has sort of matured, there's certainly therapeutic modalities that you don't have access to for CROs. But if you're in the, say, antibody space or small molecule space, then there's certainly many, many compelling reasons to consider operating as a virtual company. There, your R&D spend all of a sudden becomes close to 90% of your expenditures, versus general G&A goes down to 10% or less. Obviously, that's not accessible to many, many technologies, anything like AAV, cell-mediated therapies, or discovery platforms. You can't do that. But for us, it was really the right decision to go almost fully virtual and then direct CROs to do the work that we needed. And because there's that sort of modular approach, we're actually now working with 5 to 6 different CROs. Some do chemistry, some do toxicology, some do our pharmacology. And so that's sort of a method of operating that I've gently nudged many other companies to consider as well. It's very effective cost-wise and time-wise.
And just to sort of build on that, Mark, when you were first talking to investors, did that surprise them? Were they sort of comfortable with that notion? Did any of them try and encourage you to move to different locations?
Yeah. So 2018, that was a very rare operating model. I think 2020 and beyond it is, and perhaps Fei could speak to this with some of the other ones that she's working on. I think that we're going to see more and more therapeutics company push that way. Ultimately, you'll wind up for your GLP and GMP work, you need to use CROs regardless. So I think many investors are getting more and more comfortable with integrating with those CROs, even in the discovery stage. It's for biotech startups, it's not a question of if, it's a question of when you'll start outsourcing your work into the GLP and GMP setting. And for us, that when was just much earlier. And I think that's a general shift for the entire industry.
Right. So Fei, can I ask for the investor perspective on location? So first, do you sort of concur with Mark that you're comfortable with the sort of virtual model in the sort of early stages, and then but I think I'm asking both more specifically for BI, but more generally for other investors. Do you want to bring the companies to you, or what are you comfortable with in terms of where the companies are starting out?
So I will say, if you told me you want to build everything in-house, that's almost a no for us, for pretty much all the investors. I was at this point, say, if you want to have everything under your control, under your roof, building out full-fledged from the seed round, that's impossible, because that's almost defined as not using proceed very wisely, very efficiently to build everything yourself. And also that's kind of sending a bad tone of you want to control everything under your roof, right? So I will say how to find a way to collaborative working with others is the key for success here. So I would say location-wise, we're very flexible. So we find the Zimmer from the paper, and we agree to build the lab because we do feel being very close to the scientific founder, and if scientific founder also very willing to engage during the company formation and everything, we are open to locate wherever is most beneficial for the company to grow. We don't have to say you have to be in San Francisco and Boston, because that's what the ecosystem of the funding are. That's one consideration. If everything being equal, yes, in Boston and in San Francisco, it's easier to raise money because most fund has office there. But I will say, because nothing is ever being everything equal, because be close to entrepreneur home field, their lab, continue collaborating is also very important feature we consider. And even for Aeropath, I would say, interestingly, we find the best CEO is in England. So we're even willing to form a UK subsidiary, even go through the legal process. We think it's worth it. It's again, for us, is weighing pro and cons. What is the beneficial bring to in a more non-hub area, going through the legal process to even establish an overseas subsidiary versus what bring the success to the company could have this additional piece. So I would say it's never one formula for us. We're very flexible. We will do whatever it takes to make the company successful.
Right. Thank you so much, Fei. So, okay, so I'm now going to sort of switch tacks. We're sort of a little past halfway through, but moving into more sort of questions about process. So let's say, you know, you're building a company, you've identified what you think is the perfect VC, you sort of have ideas about sort of round size, and you've gone through your networks, you've made contact with them, and now you're sort of sitting with them and making your first pitch. Kristina, can I ask for any sort of advice you would give to prospective entrepreneurs in the audience, you know, about how best to hook those investors from that first pitch?
Well, certainly your first pitch should not be in front of a VC. It should be in front of colleagues and a lot of other people. They should be hearing you give that talk so that you know it forwards and backwards. And for us, you know, it was a process of building the pitch deck. You know, we thought we had a great pitch deck, and now looking back 3 years on, it's like, wow, that wasn't that great. And you learn a lot about how to build effective messaging, especially science communication. Is a hard thing to do. Even if you're trained as a scientist, you're not necessarily trained as a communicator. And so that can be a learning process. And I would certainly recommend there are a lot of events about this at various incubators that can help you refine your pitch deck. And for us, we actually ended up getting some professional consulting help to really level up our pitch deck. And that did make a big difference for us. In addition, you know, the key points of your pitch deck you should have in elevator pitch form, because you may be giving a pitch in places that are unexpected. So you'll certainly be in a boardroom, but you may be in the lobby of a hotel, like I was, or you may be in, you know, a back room in some office in rural New Hampshire. You don't really know where you're going to end up. And so you should be able to give a pitch in very different environments, perhaps not even with your slide deck. So you should be able to give a chalk talk, as it were, and be able to give your pitch without a lot of assistance. And that takes a lot of practice. So, you know, you have to make sure that when you're giving a pitch in the environment, you know your audience ahead of time. So you know what level to bring, you know, what tools to bring, because some people are much more receptive to a conversation rather than, you know, a deeply technical pitch. And others really already get the value prop of what you're trying to do. You're already speaking the same language. And so you can really get into the weeds with them. So for us, that process of learning how to speak the same language as the people we're speaking to was the vast majority of the effort. Because once you get on that same page, often people will understand the value prop so well that you can go beyond that and really start thinking about the future. And that's often like the relationship building that Fei mentioned. That starts in that first pitch, and where you can kind of take it to the next level in the next meeting. And it's not the end all be all, the first pitch. You're going to have probably 3 or 4 more with that group as you get from one level of associate to the next, to eventually the decision makers. So it can take some time. You're not going to necessarily give the same pitch to the associate as you do to the decision maker by the end. So it's certainly an evolution, even within, you know, one group that you're speaking to. But we found that our pitch got more refined over time because we learned during each pitch what was working. We tested out different strategies. And so by the end, we were able to be much more effective communicators of the work that we were doing.
Great, thank you so much, Kristina. Mark, any sort of tips and thoughts you have from your experience with KayoThera?
Yeah, Kristina's rhymed, if not was perfectly parallel to our experience. My first pitch that I went to a VC fund with was atrocious when I look back on it right now. Like, I'm not saying that yours is bad, Kristina, I've never seen it. Mine was embarrassing, right? And so I think that you pitch first with your colleagues, then you pitch with some VCs that are not your highest interest. You know, you want to have 3 to 5 different routes where, you know, you do learn the language, you get feedback on those really, really obvious things. And then you just sort of use those as, as your practice rounds. And that can be very helpful if you have a personal friend within those VCs, because that personal friend may get you to, even a second round discussion with them where you'll get a chance to hone your pitch. And then finally, once you get into the pitch with major, the one that you're really interested in, you'll tend to have a first pitch with a scout, an associate, maybe one or two subject matter experts in the team. And then if they're interested, you'll go in front of the larger board. And that second meeting, I think, is the most critical one, because that's going to determine if you sign the CDA, if you go into diligence, if you've got sort of a second round of, more in-depth confidential talks with them. And so the most important thing that I'd say there is credibility. When you go in, there can't be some biological question that should be known in the field that you don't have the answer to. On the flip side, questions that, are unknown, it's acceptable and preferred that you let them know that you don't know, but that you can try to find that out together. And then that's the point of the research. But you need to make sure that you're highly credible as an expert in the field, and that your team is credible and that your technology is credible. If there's even the faintest hint that your IP is not fully protected, or that the team doesn't really know what they're doing or what they want to do, that's a major red flag. So, I'd say credibility, that's your number one.
Great. Thank you, Mark. So Fei, coming to you, looking at this issue from the other side of the desk, what are things you hear in first pitches that excite you and make you want to learn more about these companies, and what are the red flags that will probably mean that that prospective company won't get a second meeting?
Yeah, so I will say I cannot agree with Mark's comment more. I speak about building trust before. I will say if no credibility, there's no trust. So then we can certainly not go into this very long-term relationship, going in, give you money, give our time to a company like this. So I will say credibility is everything. You don't have to know all the answer. As long as you are willing to following up with sincerity, I think it's all accepted. I will say I add two more things. So what makes us excited is unique selling point. Very clear articulation of value proposition. What you can do that other cannot do. You don't have to give out your secret sauce. All you need to tell me is exactly what you can achieve with your secret sauce. Is the what you can do, not how you do it. But tell me what you do that other people cannot do. That's number one. That will get me excited. Second is do not tell me how, spend like 10, 20 minutes to tell me what's the market is going to look like if I got this therapy. I will say you are not going to convince an investment group if that's not their strategic focus. Like say KayoThera. We all know what solid cancer market is going to look like if we got a perfect drug. You don't have to waste your time to convince me if I got this drug, it's going to be great market making billions of dollars. We know that. We have bigger market group behind us to do these analysis. So don't waste your time on that. Spend every minute to articulate very clearly what's the value proposition make you different from everybody on the street.
Fantastic. That's a really wise words. Thank you for all three of our panelists there. So moving on. So now I've given my first pitch. Well, I've given multiple pitches. I've managed to cite the right people in the organization. I've worked up through the chain and got to talk to the decision makers, and they're intrigued. Then we're going to move into diligence. So how did you find the diligence process for a prospective entrepreneur that's looking to raise their first sort of 10 or $20 million round? What should they expect? How long will it take? How in-depth is it going to be? Mark, can I come to you first on this one?
Yep. So that whole process is going to be quite long. If you're going for a Series A, you're looking at 6 months, likely on the average, unless you have a group that wants to move really quickly and say you're starting from scratch, where there isn't actually a lot to diligence. But if you've been operating for 2, 3, 4 years, you'll have accrued a number of contracts. Patent applications, actual, say, chemistry, biology, technology work, all of that data, as well as the high interest contracts and the high interest IP, that all needs to be reviewed by the company on a first round. And so that process is going to be about 2 to 3 months. After that's past general muster, internally with the group that you're going forward with, whether that's both their consultants and their internal members. Then you'll go to sort of a second stage of diligence, which is a really exhaustive, every single contract you've ever signed, everything that relates to IP assignment, almost every piece of biological, chemical, technological data that you have generated, you will make available in the data room, both to the investors as well as their outside counsel and their outside consultants in order to review. And so it truly is due diligence. There's no real stone that goes untouched. So in order to successfully transit from that, you need to make sure that your company is very well buttoned up from day one. You want to make sure that, on day 2 after formation, your 83Bs were filed, that your certificate is in good standing with Delaware, that all of your contracts haven't expired and you have consultants that are, say, working on an expired contract, still generating IP. All of these things create issues that really add a lot more headache than the initial, effort would be to get over them, or even to pay a lawyer early on to make sure that you don't have those issues. So I'd say make sure you're well buttoned up, make sure you're well organized from day one. An ounce of prevention is much better than a pound of cure. So, be prepared for a very exhaustive diligence process if you have a lot of, history as an operating company already.
Thanks so much, Mark. Kristina, do you have similar experiences of the process, or?
Yes, definitely. It was a very long process, certainly months longer than initially anticipated, in part because you're going back and forth, redlining term sheets, getting really deep into the questions of what the money is going to be used for, how it's going to be used, and looking at all of your contracts. We spent a lot of time filling up the data room with more and more information as was requested from the different levels of people that have given you term sheets. Because we had 2 lead investors, Illumina Ventures and Samsara Biocapital, and then a series of other follow-on investors, and they all needed to be able to see this information. So that was a process. And then, of course, the outside consultants and outside intellectual property lawyers that are going to be looking at all of your patent applications. We spent a solid amount of time doing extremely deep dives, discussing individual words in our patents as they were compared to patents that were related out there in the field. Probably more time than a scientist would typically spend on language like that. And you certainly need to have a really excellent IP lawyer with you to guide you through that process, because then they can help you build IP going forward that can be even more protective than what you have. And so I actually found the diligence process to be really illuminating and to help us then write better patent applications as we continue to expand our own portfolio. So I can't emphasize enough having a really great patent lawyer and a good relationship with them, so that you can have this back and forth process going forward, so that your next round of diligence, you'll find that I think that will go much more smoothly.
Great. Thank you so much, Kristina. Fei, does the experiences that Mark and Kristina have had sort of chime in with how BI approaches the due diligence process?
Yeah, so we're very thorough, I would say. A lot of company we do build from scratch. So we are the one helping them to register for the Delaware C Corp. We are the one hire them, the law firm, pair them with the IP lawyer. So we do have a lot of experience doing so. But I would say if a company come to us already have all these ready, the due diligence process, I would say at least from we first initial touch base, know each other, we sign CDA, to we close usually take 1 year. I would say that's pretty common. But when we decide to lead, the good news is we have a huge network behind us. A lot of our co-investing with us, because every single deal we do, we syndicate. Not only because money-wise we share risk, but more importantly, we believe every investor coming to the boardroom bring their expertise and network to can help the company to more successful. So every deal we do, we syndicate. So we've been existing for 11 years globally. So we have a very large network we can bring in. And a lot of them have worked with us before, trusted us. If we're in, we share our due diligence material, they can come in board within 2 weeks from the beginning of touching company until they decide to come in closing with us. So I will say for us, usually take a year or sometimes 1.5 years. Like for Zimmer case, we only have 1 paper from day one. We forming company, that take a lot longer. But I will say normally we'll take expecting at least half year to 1 year time frame until closing.
Great. Well, thank you so much. That's a very consistent message there. I think everyone's hearing, and also sort of chimes with our experiences at Princeton of how long this process takes. So now moving on. So we've made the pitch. We've hooked the investor. We've gone through the diligence process sort of successfully. We're now into like negotiating the deal itself. And Fei, I'm going to come to you first on this one because to get the investor perspective, how do you approach valuation for an early stage company or one that's looking at a Series A round? This is particularly, when we're still a very long way from revenues.
So I will say it's every fund view this differently. Some founder will say it's more to the market like housing. How much a house really worth is less relevant how much material I spend to building it. It's about market, how much demand I have. In that case, I would say 2 years ago, the valuation would be very, very high for a company. Now we are all see valuation dropping down. But BI take a slightly different approach, and I would say every fund is different here. We are more tied with data. So if you only have a concept, the pre-money usually is 3 to 5 million range. If you have some initial data in vitro wise, have just in vitro kind of proof of concept, that's usually a single digit million. If you have a very solid in vivo plan, in vivo data already, that's usually like a teen pre-money. So that's rule of thumb. Again, there's a lot of variation in that there. There's a lot of, I would say, how much really the IP is owned already by a company and how much need to be in out licensing out from university, how strong the IP is. I would say many things factor into here, but again, I would say the very tier A fund always will decide is going with data, not going with what's the market value, very high value, because that's what we understand in the long term is not helping company to build success. It's imagine if your pre-money is really high, then I need to give you a lot more money to make the value, my investment worth it. Then you eventually build a zombie company. Nobody wants to take over in the next round. Then you stuck. So company will tank in that way. So I would say a good board member, a good investor will really value what's the data package look like based on the true scientific merit behind it and the technology potential behind it, and the team all factor into a pre-money evaluation.
Thank you so much, Fei. And just one specific question from the audience. If you're looking at a platform technology versus a sort of set of more direct solutions, does that impact valuation significantly?
Definitely.
And how?
So I would say majority of the fund we work with and people always prefer a platform. The reason is single asset is much more riskier. Unless your single asset is a true transformative, that asset play out is going to be change the world that works like an iPad today, let's say, if that technology. Things are usually not that black and white when it is, especially in the early stage. So within a platform play, you definitely share risk as a product engine. If the lead asset die, I have more coming out. But also that point often is the discrepancy between the scientific founder versus fund. The fund like to see a platform play more likely because even replay the error path piece when we discussed originally with the scientific founder Zimmer. I think the view is slightly different, but again, open-minded, trust each other. That's play into it. So we really working together and shape a platform behind the lead asset. We will push the lead asset, as far as we can, but the platform is also important. So we would definitely prefer to see a platform play rather than if you only are a pathway expert. I only have one asset and everything is bagging on that one asset. That's certainly much more riskier. So I will say, yes, the evaluation will be lower for single asset, just generally speaking. A platform will be slightly higher, but again, there are many factors playing into this.
So thank you, Fei. And then so coming to Mark and Kristina, obviously this can be a sensitive issue for a for a company founder. The company is your baby. You worked to develop it to this point. You want the highest, or you think you want the highest valuation possible. How did you find this sort of process of agreeing on valuation with your investors? Was it challenging? Kristina, can I come to you first? Or
I guess I don't have as much an insight into the valuation conversation as Mark probably does. So why don't we go to Mark?
Okay, Mark, you're up.
Yeah. We had the benefit of having a couple different term sheets. So because of that, we were able to leverage, and this happened, this was sort of by design as well. So you're able to leverage sort of the highest valuation from the term sheet that you don't want to the company or the VC firm that you want to go with. So, if you only have one term sheet, I think you're sort of at the mercy of the investor to give you a fair deal. And, by the time you make it all the way through, you'll know that investor well. And, I think you can hope to have a fair transaction. But it is much, much easier if you have a competing offer with which to negotiate. So that being said, I think the numbers that Fei put out are very reasonable, and they're sort of, they're becoming pretty well standardized, and most people can look to those other comps and look to them and say like, hey, this is another company similar to where we are. Let's try to benchmark according to that. And we certainly did that as well. Had we not had a competing term sheet, we also had a valuation in terms of comparables, as well as a valuation in terms of discount cash flow. And so all that's sort of, it's not set in stone. It's very variable. So you're really trying to make a best guess. And ultimately what drives your valuation is what is your board going to accept, and what are you as a personal shareholder going to accept? And that sort of is going to set your minimum. And then the maximum, I guess, is, how good of a negotiator you are. And so it also bears speaking to that there are many other terms in the term sheet and in the financing documents that's going to affect what that valuation is and how fair it is. So will you be granted options down the road? If you are, then you could potentially take a lower valuation up front. Is there anti-dilution with a single, double, triple ratchet? Are there preferred participation 1x, 2x, 3x clauses? These are all things that go into the big pot of figuring out what you think is acceptable to take for your company.
Great, thank you. And you're sort of leading very much into what I was going to get into next, which is sort of structure. Is there a sort of classical structure at the moment in the market for how you would put together a Series A? Is it typically preferred? I'm sure it's sort of preferred rather than sort of common equity, but is there a standard participation preference? Is convertible debt ever a sort of model that's used? I don't know, Kristina or Fei, if you have sort of insights you'd like to discuss here.
I'm happy to go first if
Sure.
Okay, yeah. So I will say we can do any kind of structure. To be honest, I will say our first check is very flexible, can be a couple $100K for a very defined experiment scope, or we can be first check could be 10 million into a 30 million round as a lead investor. So I would say it's very, very flexible structure. I would say whenever money come in, the money buy for price per share is always preferred share. So that's I would never, I don't think it's possible for us to get a common share, but common share is usually for the scientific founder or co-founders, or ESOP that are coming from the shares is always common case. But echoing back for what Mark said, there in the term sheet, there is a lot of different way to skin the cat, to be honest, where the ESOP is structured at. Is that pre-money? Sometimes different tranches. Each tranche has a step up. It's many, it's almost you need to discuss with the lawyer. And if some investor friend or even your leading investor you trust, let them walk you through what exactly each term means if it's your first time. I think that's very extremely important. Somebody you trust will walk you through. Say, if I were you, A, B, C is what I would negotiate. So I would say people have experience able to teach you that. That's very important. For the liquidation preference, I will say for BI venture fund, for our invest, we will never, it's not never, but very rarely we will accept just one return, no liquidation preference at all. That's quite rare, and especially in this market today, I would say it's almost impossible now. This time you can get that kind of term sheet. Even in a very, very good market, for tech fund, maybe you can find these kind of term sheets, say, okay, just return one money back to investor, no liquidation preference, come immediately do pro rata. That's I would say in that case, then you ask why investor even invest, right? They only get the one money back. They don't get any additional things. The liquidation preference is to protect medium exit, means they are slightly more than what they invest in, but not to the part everybody will converting into common. So I would say that's probably the most complicated term in the term sheet to understand the exit waterfall, what things should look like in a medium sell kind of situation, exit situation. But I would say usually often we will do either two return back to the investor, then pro rata for the common share participation, or we will do one return, then we will participate to a cap. That's very common for I would say all the term sheet out there. But now it's a different market. I don't know what really the new dynamic they're going to bring us. But I was in the past few years, that's what since we started, we always do that in the US at least. Every territory is different. I would say we have global team. In Asia, people do very differently. In Europe, people do very differently. So it's to do with the market standard. In the US, market standard is somewhat participation from the in different ways to do with how good negotiating is and how reasonable you are, because every argument we put forward for term sheet negotiation you have a logical rationale behind it. So I think that's kind of negotiation key for what kind of liquidation preference in the end you're getting.
So thank you, Fei. And I think you sort of raised a point I'd just like to get sort of Kristina and Mark's opinion on. So, a term sheet can be a very complex sort of financial document, and for a scientific founder in particular, maybe relatively unfamiliar. Where did you go for sort of advice and support in sort of understanding it, in where necessary, sort of negotiating it with your prospective investors?
Certainly for our part, we had corporate lawyers that had been through this before, and there was a lot of conversations there. Also speaking to other CEOs and getting their perspective generally on certain types of term sheets. And we had sort of friendly VCs that we had been forming relationships with over time that we could go to and ask questions, perhaps that were not necessarily in our field, like we're in therapeutics, and so didn't really have a stake in a dog in the fight, as they say. And so could give us some kind of unvarnished advice about these different term sheets.
Mark, any different experiences for you?
Yeah, I mean, your lawyer should be really a good lawyer in the Series A realm, is representing the company, but should be able to help to advise both the company and then give an insight to the founders and the current shareholders about how that deal will affect you. Of course, you're going to be paying $500 to $1,000 per hour for that advice. So, you want to make sure that's a really good lawyer there. On the flip side, throughout the entire process, you should be making friends and good contacts throughout the field. And the field is collaborative as a whole. I've seen very, very few conflicts between venture groups, between consultants. Everybody's sort of very willing to help out to make sure that, the field in general is operating on the same plane and that it remains friendly. So you'll benefit from that. And to some of the other accelerators that we spoke about, your business advisors, all those people will have seen term sheets before and be able to help you out with it. Now, the other thing that we haven't sort of touched on is that I think all financing should be done on the basis of the NVCA documents. There's no reason in this day and age to be deviating from standard NVCA terms. And just about every single lawyer as well as advisor in this field is going to know what NVCA standard is and what deviates from NVCA standard. And when you get those deviations, those are the areas that you really want to spend the time on.
Fei, would you agree with that notion?
Absolutely. I will say for our internal even lawyer, if we usually the first thing to do is compare the document to the NVCA template for any red marks, then now we dive into to do that. I would say that's a very good practice for the new entrepreneur to save your lawyer money. Just like Mark said, every minute you talk to a lawyer takes money. It takes like a certain fee. So again, I would say going back to the trust, finding somebody you can trust. Why you can trust your lawyer? Because financially you tie this together. You hire them, they're supposed to be service for you. You talk to your VC friend, you trust. You talk to anybody you can find in your network, had an experience, but you trust will do the best for you. That's I think the rule of thumb.
And Mark, so just a question from the audience, could you talk a little bit more about the NVCA and where someone would find it, how to learn more about it?
Yeah, you can just Google NVCA, National Venture Capital Association, and you'll get to their form documents. And the site is relatively easy to do. The other thing that you can get is actually just about anybody that's working off documents in there will have their own NVCA docs that have come off, maybe with pre-filled pieces along it, and you can largely get those templates. So something that I did really early on, as well as during financing, is I just emailed another company and said, hey, can I use your consulting agreements? Do you have NVCA stock consulting agreements? And so instead of having a lawyer draft our entire own set of templates, we could get somebody else's work that was already done, that was done on the same templates, and we could just use that. And, you're not sharing proprietary information between companies. So, you can go both to the NVCA as well as to other colleagues in the field, and you can get, a very nice set of documents that are fit for purpose.
Great. And then I guess one more sort of practical question. The sort of time period from moving from an agreed term sheet to sort of final closing documents. So how long did that sort of take in each of your cases? How long should people expect that process? I guess the getting all the sort of legal ducks in order to take.
For us, that was on the order of weeks, in part because the diligence process had been so long that we had a lot of time to iron out all of these details. And as I mentioned earlier, we were adding investors during that process. So it was relatively quick after we had gotten through all of those red lines. But nonetheless, as you begin the process, like we said, it's total of about 6 months. You really need to be thinking about other non-dilutive sources of funding so that you have a little bit of breathing room if you're getting to the stage where you're kind of getting close to the end line and of running off the edge of your financing. So you really should be preparing earlier on for this raise and have backups and non-dilutive sources as well.
Great. So we're coming into sort of the last 10 minutes here. So I just sort of last call to the audience. If you have any final questions for the panel, sort of please send them in. But in the meantime, I guess would like to sort of go around and ask sort of each of our panelists if you had any sort of, I guess, single overarching piece of advice that you would look to provide any aspiring entrepreneurs in the audience. What would that be? What would be the number one thing that you would sort of recommend to an individual who was looking to go out and raise a Series A? Kristina, can I start with you if that's not too unfair?
Yeah, no, that's fine. For me, I think you're going to have to step out of your comfort zone in so many ways. You may, if you're coming from if you're a science founder, you're going to be stepping out of your comfort zone in public speaking and networking, in science communication. So you really need to be willing to do things that you probably may not have been trained to do, and ask for help a whole lot. As was mentioned earlier, it's a very collaborative environment, entrepreneurship in general, and you'll find many people who are willing to kind of go above and beyond. I was very surprised at an event I went to in Boston. Someone I had only met a couple times was willing to give me a list of all of the VCs and angels in the Boston area, saving me, I don't know, hundreds of hours of time, just compiling them, getting those email addresses from someone who had already been through it. And so really that networking piece was so important. And it can, be difficult to go to so many of these events and meet so many people. And so I think you're just be prepared to step outside of your comfort zone and get familiar with failure, because you're going to do a lot of pitches that don't go well, or pitches where it's just not a good fit. And that's okay. Every pitch is practice for the next one, for the right one. And as Fei has mentioned, relationships are the most important. So this networking piece is not just shaking hands with somebody and never following up with them. You actually need to cultivate relationships, not just with entrepreneurs, but also with VCs.
Thank you so much, Kristina. Mark, same question to you. What would be your sort of major piece of advice for an aspiring entrepreneur in the audience?
Yeah, I would say be humble. Be humble about every single thing. First, it helps when you're meeting with VCs, that humility. To what Fei said, they say coachability. That's a very common term that you hear, but I think that's just a synonym for being humble about what you're doing. You want to have data that speaks for itself. You don't want to have an ego that speaks for yourself. So, when I say that, you need to be humble about what you don't know and then take steps to learn what you don't know. You need to be humble about the people that you hire and know that those people are better at what they're doing than you are, which is why you hired those people. And I think you need to also be humble about people telling you no and that you're wrong, because those are, when somebody has the conviction to tell a founder or CEO who is paying them that founder or CEO is wrong, then they usually have a really good reason for that. And so you should listen to it.
Great, thank you so much. And Fei, so question, what would you sort of one piece of advice to an aspiring entrepreneur that might be thinking of approaching you for a capital raise?
So I will say Mark mentioned a very important word. I think one of my very respected mentor taught me 2 words when I was very young: humility and empathy. So humility, Mark already elaborated on. Let me say a little bit about empathy. And only with that too, you can establish trust in the relationship. And empathy means you think in the other people's shoes. What if you were them, what you would do? That happens a lot in the scientific discussion as well as term sheet negotiation. Is they want that. You think in their shoes. If you were them, would you want that same thing? I think that's also very important. So I would say humility and empathy, and ultimately building trust.
Great, thank you. So one, I think, terrific question from the audience that I might like to sort of finish on. So mostly for Mark and Kristina, is there one thing in the process of raising your Series A that you went through that you wish you had done differently? So, I see we're both having a little bit of thought about that. Mark, I'm gonna come to you first on this one. Is there?
Yeah. So by the time you get to a term sheet, so the whole process is really exhausting, right? And by the time you get to a term sheet, you've made it through due diligence. You're just happy to get the term sheet. In many cases, you're in a rush to sign it because it's something that you've seen as a light at the end of the tunnel the whole way through. I would recommend that you take some time to make sure that you're comfortable with the broad overarching terms in that term sheet. Because that is really the time to negotiate. It's not the time after you have a signed term sheet. So if you're at the term sheet, you want to sign it, it is worth enumerating any things that you think the term sheet is unclear on that you may want to visit a little bit later. And that's a tall order, but for us, I think it would have been helpful if, because the term sheet's 3 to 4 pages, your financing documents are 200 pages. If there's something that you think the term sheet doesn't cover that it should, or something that is going to come up during the financing that you're not certain what the investor thinks of, you should clear the air before you sign that term sheet there. So, the air should be entirely clear at or around the term sheet, and there shouldn't be major things that pop up during the closing process. And so that is probably where I'd go back and would have gone over, spend a little bit more time on the term sheet, made sure that we were on the same level with a number of those different items. And then we would have cut our closing time from 8 weeks down to 3 weeks. And those 8 weeks are really stressful weeks because you're already redlining documents.
Great, thank you, Mark. Kristina, sort of finishing with you, anything you wish you'd done differently in the process of closing the round for Fluent?
Well, I think first, I'm really appreciative of the process that we went through. I mean, I think the journey was really valuable. From a learning perspective, having been, trained as a scientist and not necessarily having taken any business classes. So I feel really grateful for having had the opportunity to be in those rooms, make those pitches, learn about everything we've talked about here today. And so in some ways, I'm not sad that we made mistakes. I think they were really valuable learning opportunities. But if I had to kind of pick one thing, I think earlier we could have gotten some professional help with our pitch deck, just because it would have saved us some time and enabled us to be more effective communicators of our value proposition, because we really truly believed in it. And every time you go into one of those rooms and you haven't effectively communicated it, it's a missed opportunity. And so anything that can help you accelerate and go faster is something that certainly we all should do. So that's one thing I would probably go back and try to do earlier.
Great. So, well, thank you so much to all of our panelists, to Kristina and Mark and Fei for a really sort of, incredibly insightful and interesting discussion about the sort of many sort of complex issues that that go into raising an A round. So my main job now is to sort of thank you all, and I'm sure we're all hugely appreciative of your time and insight today. Two more quick closing words from me. Firstly, a little plug for the Princeton Entrepreneurship conferences. On Friday, April the 7th, 5 till 7 p.m., there is the 2022 New York City Tiger Entrepreneurs Conference Startup Showcase. So if anyone is based in New York City and would like to sort of continue discussions to meet people, that's a great event, and we would encourage anyone to come along and attend. As I say, that's next Friday in New York. And a final practical note, the whole of today's session, it has been recorded, and the PICB's, Princeton Innovation Center Biolabs, will be making it available both on their own website and via their own YouTube channel. So if anyone on the audience sort of missed part of the panel discussion or would like to share this with colleagues, you should be able to find it to share in the future. But other than that, I would just like to thank you for being a great audience, so many useful questions, and wish you all a very pleasant day. Thank you.